So first of all, we're going to take a look at the overview of the market, and that's from a higher time frame, and I will explain to you why I think you ought to be very careful at these stages of the market. Because the market, as I have said in my previous video, one of my previous videos or several of them, the market is in a precarious point, in my own opinion. So you want to be very careful investing at this point. Okay, when I talk about investing, I'm talking about putting in a long-term trade, maybe something you buy a stock for 1 year or 5 years, that kind of stuff. So you want to be very careful. You can trade, you can go into the market, come out, buy, sell. That's fine. Those are swing trades or scalping. Those are quite fine if you know what you're doing. All right, so let's take a look at the chart here. This is Nasdaq futures. We're going to take a look at the higher cycle of the Elliott wave for the Nasdaq futures. So let me put this in a logarithmic format so it will be a little clearer. So this is what I have on the monthly time frame for Nasdaq futures. Now note that I'm starting at this point. That is the end of the global financial crash. There is data all the way. For example, for SPX, you have data all the way probably to late 1800s. That's fine. You can look at even bigger cycles from there. But for now, we're going to look at this big cycle and then drill down a little further. When we get to those bridges, we'll cross them. But for now, I think this is just what we need to look at. And this is sufficient for us, quite frankly. And we'll see how things play out in future. So based on Elliott wave, this is what I have for this cycle. 1, 2, 3, 4, 5. Okay. And then you drill down a little bit more. You go down to the weekly. You have 1, 2, 3, 4, 5. And when you drill down a little further, coming down to the daily, that is where we currently are positioned. You have 1, 2, 3. We are currently in 4 and then 5. So the wave colored in green is for the daily, the lowest level. And then you move up a notch. The blue wave is for the weekly, and the black and thicker line or wave is for the monthly. This is where I think we currently are. That's why I say you ought to be very careful, because we are not just completing this wave, we are completing this wave and we are completing this wave. Okay, so what this means is that the correction, when it starts, is going to be a lot bigger. It's not just something that is going to stop here, it's going to go all the way down, correcting for this. All right, and then you have larger waves or larger cycles on top of this. Okay, so you want to be very careful. Let's take a look at another reason why I think you ought to be very careful investing at this point in time. So let's go to the monthly. Now, when you take a look at the price action here, and then you take a look at this indicator, this is the RSI, is a momentum indicator, relative strength index, and then you take a look at the MACD, you see that there is a divergence taking place. All right, so I'm going to draw the line. So this is a divergence. The value here is 84.93 and the value here is 82.41. So there is a divergence from this point to this point, and then further divergence from this point down to this point. So divergence is when you have an indicator, for example, the RSI, going opposite direction as the price. So as the price is going up, the indicator, the relative strength indicator, is going down. This is a forewarning that this trend is about to end. The trend that is going up, this upward trend, that is, the market is about to change direction, is a forewarning. So you need to be very careful. That's the second reason why I said you ought to be very careful. So the first one, the Elliott wave analysis. The second one, the technical analysis by way of comparison of price with the indicators. The second indicator is the MACD. As you can see, there is also a divergence here, or a divergence that is forming. Yeah, this hasn't crossed yet, but you can see is kind of tending down here and might cross very soon. So you want to be very careful. Meanwhile, price is going up. So let me delete these lines. So that is the second reason why I say you ought to be very careful investing at these levels. Now, note this is the monthly time frame. This is a big time frame, people. It's a big time frame. So you want to be very careful. If you go down to the weekly, you're also going to see these divergences. All right. You see the divergence here from here to here to here to here. And with regards to the RSI, same divergences from here to here to here to here. So while price is going up, the indicators are showing that this trend is about to end. That is why I said you ought to be very careful investing at this point. You don't want to be dumping money at these high prices into stocks while correction is about to start. I mean, if you're buying something, say for example at $100, why not just keep that money and buy that same thing at $50, for example, if it's going to correct that much. All right. So another thing about bear markets or big corrections is that they end relatively quicker than bull markets. Okay, bull markets take a long time, you know. But depending on what correction we are going into, it could be a major correction. You know, remember I told you about the cycles, the bigger cycle, the smaller cycle, and then the lower cycle here. Okay, so 3 cycles. And remember we started at the GFC 2008, 2009. There are higher cycles of Elliott wave, you know, that could also be terminating that need to be corrected. So by the time it's not going to have a cascading effect. You know, it's not just going to correct for this smaller cycle. It's going to correct for this smaller cycle, correct for this next bigger cycle, and correct for this next bigger cycle, and possibly correct for another bigger cycle, and maybe even another. All right. So it might be a very big correction. All right. And may take a while. So you don't want to go invest at this point because definitely going to affect your bottom line. You don't want that. All right. Okay. So these divergences is the second reason why I say you ought to be very careful. The first one, Elliott wave. The second one, the divergences. Let's take a look at the third one. So what you have here is the yield curve compared to the stock market. So you have the 10-year yield minus the 2-year yield. When this yield curve uninverts, all right, this is an uninversion of the yield curve. This is not normal. Okay, anything below here is not the way things are supposed to be, because what is telling you that the 10-year yield is less than the 2-year yield is not supposed to be. The 10-year yield is supposed to be higher than the 2-year yield because you're assuming more risk in buying that treasury note, because any treasury between 2 years to 10 years is called a T-note. All right. So you're supposed to take more risks investing in longer time frame T-notes, T-bonds over T-bills. All right. As you can see, you have the first uninversion here, another uninversion here, another uninversion here, and another uninversion here. So when it comes below, it's inverted. When it moves above, it's uninverted. It goes back to normal. And the key thing about this is that anytime it uninverts, we've had a crash. At this point, this was in the 90s. There was a little crash, about 20%. You know, there was a 20% crash around here. Take a look at this one. When it uninverted, we had a crash here. Here, when it uninverted, we had a crash here. This was the .com. This was the GFC, global financial crash. And then we are coming down to this point where it has uninverted again. So you want to be very careful. So this is the third reason why you ought to be very careful investing here. All right. Because for all you know, the market has stopped and we are headed for a major crash. Okay. So that's pretty much the end of this overview. We are going to now go deeper or zoom in a little bit more to look at our scenarios and then prepare for next week. Okay, so remember the last video that I had a couple of scenarios, and one of those scenarios was that we were going to come up here and then continue going down. That's the reason why I had this red box, and I actually left it just so that you can see what happened. Please go and watch that video again. I'm going to attach it at the end of this video, and so that you can see my explanations. The only thing being that we went a little bit above it, and we started heading down. All right. I saw a lot of people on Twitter, talking about double bottom here, buying NVIDIA calls, shares, and all what and whatnot. And I was like, wow. So you ought to be very careful out there, people. There are a lot of big accounts. The fact that somebody has a large following doesn't necessarily mean the person is correct in his or her analysis. You just want to be very careful because it's your money. The fact that somebody says buy doesn't mean that the market is going to go up. Nobody knows tomorrow. I keep on repeating this, and the market doesn't care what you think or what you want. The market does what it has to do. You just have to follow the market. You have to learn to follow the market and not go ahead of the market and presume that the market is going up or going all the way up. That is why you need to trade from level to level, okay? And at least have an idea of what are the things that should happen before you enter a trade. And then you set your stop loss. If you're wrong, you lose more. If you're right, you win big. Okay, I traded this and made quite good amount of money. Yeah, I exited at this point. I'm not very happy about it because I had some criteria which I was waiting for, which was not met, but I was just playing safe and I missed out all this, okay? But that's fine. It's better to make money than lose it. So any win is a win. Any profit is good profit, all right? That's the mindset you ought to trade with. Limiting losses and allowing winners to run, all right? It's a skill set you develop as you trade, and it's very critical. The big thing is do not assume that the market is going up or going down and you just put in all your money and you go to sleep or you go on vacation. Okay, this is a very volatile period. The market is in a very volatile. You can see that the swings are very high. I mean, within a day, Nasdaq could lose 300 points. SPS could lose close to 100 points. That's big. Okay, that's high volatility. We're in high volatility period now. All right, that's why the VIX is going up. Okay, so you want to be very careful. Now, the question is, where are we headed from here? So I have 3 scenarios. All right, I have 3 scenarios. This is the bull case. Then I have 2 bear case scenarios. So let's first of all take a look at the bullish case scenario. So this is working on the assumption that this is a WXY, all right? We have completed the W, completed the X, and we are now heading all the way down to Y. And my expectation is that the Y terminates around this area, okay? As you can see, you have a whole lot of support around here and a lot of activities around here. So there is a possibility that the market terminates here. I have an indicator that I have put together that I also watch to tell me when to go long. And it's almost to that point where I'm supposed to go long, but I'm just being patient. Also, there are some other things I consider that I look at that informs me on when to go long or when to exit or go short, all right, or exit my current trade. So this scenario assumes that we're coming down here and we are going way back up, making an all-time high. Personally, I still think that the market has at least one more high to go. That's my own thoughts. I could be wrong. That's why you ought to be careful. Nobody knows the future again. Nobody knows what the market is going to do, but you have to do some form of analysis and assign it a probability. Trading is a probabilities game. Nobody knows the future. Nobody will come and tell, oh, the market has stopped, oh, the market has all this kind of stuff. You know, you ought to be very careful. All right. So it's a probabilities game. And I assign a very high probability that the market is going to stop here and make another all-time high. So this is my highest probability trade. But even if you're assuming this, when you get to a place like this, again, as you can see, this is the point of interest, this area right here. Now let me use the box. Okay. Which also coincides with the other red box. You want to be very careful as you get here. Another place you ought to be very careful is, let me delete this. This area, all right? You want to be very careful here. So if the market comes down here and you go long, when we get to all these areas, let me just move this down. Might as well cover the two at a time. All right. When the market gets to this point, you know, looking at your divergence and several other things, your indicators and all that, if you're a trader and you know what you're doing, you ought to be very careful when it gets to this point. And I'm going to tell you why in my second bearish scenario. Okay, you ought to be very careful and actually exit your trade. Take your profit. Any profit is good profit. Don't be greedy and say, oh, wow, I'm not going to miss all. Yeah, it's okay to miss all these other. That's fine. All right. And you could also re-enter. But don't say, oh, I'm going to, and then the market corrects, goes back, and you wipes out all your gains. There are people who, it has happened to me before, I've sat on major gains only for it to turn to losses. Okay. It happens to any trader, but you learn, you know, take your profit. The market continues. There are several entries. There are several exits. There are several opportunities in future. This is not the end of the world. Take your profit and relax, you know, and thank God for the money you have made and plan again for your next entry. All right. So when the market comes here, you should exit if you enter from here. All right. Again, this is my highest probability scenario. Just like I told you in the previous video, that the market getting somewhere here and turning back was my highest probability trade, and it happened that way. Go watch that video. I'm going to attach it at the end of this video. All right. So this is my highest probability scenario. It's actually the bull case or the bull scenario, even though we still have a little bit more bearishness, and then we go up. So at this point, let's go to the first bear scenario. So this scenario is assuming that the correction is not going to end here. We still have more downside, all right? In which case, we are forming a larger WXY correction. So you complete this WXY, and that will be your circle W. Move up, that will be your circle X, and we continue down to terminate somewhere around here, being your circle Y, okay? And then from here, the market might just continue going up. So I think this is clear enough, all right? If you have any questions, please leave a comment. You know, if you have anything you want me to talk about, please leave a comment below, and I will try my best to answer it. Now that we have looked at the first bear case or bear scenario, let's go to the second bear scenario. So this is the second bear scenario. The assumption here is this is a 1, 2, 3, 4, 5 being a wave 1. All right. Then we've come up to wave 2 and we're headed down for wave 3. So we're going to have wave 2, 1, 2, 3, 4, 5, 4, 3, and then up for 4 and then down for 5. So that's the second bear case. Once this is completed, this 1, 2, 3, 4, 5 is going to be a wave 1. So it's a fractal of a bigger wave 1. Then we come up for wave 2, and then we crash hard for wave 3. Now, if this starts playing out, that really means we are in for a very big correction, guys. you know, we pretty much entered a bear market. Okay, not just some tiny correction, in my own opinion. So you want to be very careful. However, when we get to this bridge, we are going to cross it. We are not there yet, but you still want to have that in front of you. Again, this is my lowest probability scenario out of the three. All right. So please, if you gain value from what I have presented to you, if you gain value from this video, please like, share, comment, subscribe. Okay, I really do appreciate your audience. I really do appreciate you watching this video. I wish you all the best next week. God bless you and have a wonderful trading week. Thank you.